Hi everyone, this is Mrs. V Chen. Welcome to my Form 5 Business Lesson 2, and today we are going to have DSE questions related to Chapter 3, Sources of Financing, and today is 22nd February 2020. Okay, so here we have two DSE questions. Okay, let's look at the first one, which is practice paper, question 7E. The question says, lists other sources of funds for Moonflower's operations and expansion. All right, so if you want to expand your business, if you want to have another branch, you need money. Is that right? So sources of funds is about how can you get money for your operation, for running of your business, and for expansion. Now, before you answer the question, something very, very important. You must look at what is Moonflower. Okay, so if you go back to the case, Moonflower actually is a small travel agency. Okay, and then you have the name Daisy. And who is Daisy in the question? Okay, Daisy is the sole owner. And what does mean sole? Sole means only one. So obviously, what is the form of business ownership for Moonflower? Moonflower must be a sole proprietorship. Okay, so for sources of fund for sole proprietorship, so can you issue shares? Can you issue debentures? Can you issue bonds? Okay, of course not. So this is very, very important. If it is sole proprietorship, then your answer for issuing shares and issuing of bonds and debentures will be wrong. So this is the first thing I need to remind you, okay? All right, so therefore, what can you do? So you can apply for bank loans, all right? You can borrow money from third parties or from other financial institution. Okay, the usual answer. All right, and then you can invite friends or relatives as your partners. That means you change from sole proprietorship to partnerships. Okay, when you have more partners, then you get more sources of fund. All right, and then you can do what? You can pay your creditors later. Okay, so you can keep money for running of your business or for your expansion, or you can ask your debtors, your customer, to pay you earlier. All right, so this is the question here for Moonflowers, which is a sole proprietorship. Okay, so next let's look at another question in 2012, question number 7. So the question asks you about this. Sources of funds for the above takeover. So before you look at the answer, okay, what is meaning of takeover? Takeover means to buy another company. To take over means to buy another company. Therefore, what do you need? You need money. So how do you get money? So which is related to sources of funds. Again, something very, very important. You need to look at the business. The business given to you in this question is a Skyline Airways, and which is a long-established listed company. All right, what is listed company? Public listed company. Can do what? Can do issuing of shares, can do issuing of debentures, can do long-term bank borrowings. Okay, look at this. Why it is long-term instead of short-term? Because the amount for taken over must be very, very large. Okay, so therefore, it is the long-term bank borrowings instead of short-term bank borrowings. Okay, and then this is a new thing, a special thing, and I'm going to explain this point to you later. So liquidation on fixed assets. All right, so therefore to make comparison between these two questions, so something very, very important. So before you answer the question, you must study and identify what kind of forms of business ownership. Otherwise, your answer will be wrong. Okay, so since this is a limited company, so limited company can issue shares, can issue debentures, same as bonds, can do long-term bank borrowings. So what is long-term instead of short-term? Because the amount for takeover must be very large. Okay, and then we have something new here, liquidation on fixed assets, and I'm going to explain to you later on this point. Okay, so after you have mentioned all this method, and then you have to give reasons why you do issue of shares. So you will realize that all these points here are also the advantages and the benefits of issuing shares, issuing debentures, and long-term bank loans. Okay, so if you issue shares, look at this, you don't have interest burden. Why? Because what do you pay to shareholders? you pay dividend instead of interests. All right. However, if you issue debenture, you need to pay interest. So this interest burden will be disadvantage on issuing of debenture, but no interest burden will be advantage if you issue shares. Okay, and the next thing is about collateral requirements. So no collateral requirement if you issue shares. However, if you issue debentures, you need collateral requirements. All right, so and then let me explain what is meaning of collateral to you. Now we come to the meaning of collateral. So here is the meaning of collateral, but I want to use this example to explain to you. All right, so we have Cherry used her house as collateral for a loan. That means Cherry borrowed money from the bank to get a loan. All right, so if Cherry failed to pay back the money back to the bank to settle the loan, then Cherry has to use her house for settling about the money owing to the bank. So this is the meaning of collateral. All right, so therefore if you get a loan from the bank, and which is also debt financing, you need collateral. So obviously this will be one of the disadvantages for getting loan, because you need collateral when you apply for a loan. All right, but if you issue shares, and which is also equity financing, then you don't need any collateral. So this is one of the advantages for issuing of shares. All right, so therefore the first advantage of using issue of shares is there is no collateral requirement. So this advantage will be disadvantage if you use long-term bank loans. All right, so next we go back to the second advantage of issuing shares. Avoid increasing the gearing or leverage ratios. Okay, let's do some revision on this gearing ratio. Do you still remember the formula? All right, so here is the formula of gearing ratio. So the nominator, all right, which is non-current liability and the preference share capital on top, divided by the denominator, we have non-current liability plus total shareholders fund. Okay, do you still remember a high gear better or low gear is better? So we have low gear is better. What does mean low gear? That means we have less non-current liability, and we have less preference share capital. So what's wrong with non-current liability and preference share capital? So whenever we have non-current liability, we need to pay interests, right? Remember that? And whenever we have preference share capital, we need to pay dividend. All right, so these two things is always fixed. Therefore, these two things give you financial burden. Okay, so therefore a lower non-current liability and a lower preference share capital will give you a lower gearing ratio, which is better. Better means the risk is lower. All right, so the conclusion is issuing shares can avoid increasing the gearing ratio. Of course, the shares here means the ordinary share capital. Okay, so avoid increasing the gearing ratio when you issue of shares. That means this is the advantage for issuing shares, but at the same time, increasing the gearing ratio here will be disadvantage for issuing of debentures. All right, so another advantage for issuing shares, which is no repayments required. And let me explain it this way. So here, no repayment required means after issuing shares, you don't need to buy back the shares you have issued. You can just keep the money after issuing shares. But however, if you issue debentures or issue bonds, you need to always pay back the interest regularly, and also the amount you borrowed, which is the principal when the day is due. Okay, so that the conclusion is the advantages of this equity financing, because issuing shares is same as equity financing, will be just the opposite, which is the disadvantages of debt financing. All right, so therefore you can see all the advantages for issuing shares will be disadvantages for issuing debentures. So advantages of equity financing, which is same as issuing shares, is same as disadvantages of debt financing, which is issuing bonds and debentures. All right, so now we come to advantages of issuing bonds and debentures. The first one is no dilution of control and shareholdings. So here is my diagram and explanation. So dilution of control happens to issuing of shares, but not happens to issuing of debentures. So the explanation is here. So for example, this is the limited company, BAFS Limited issues 1,000 number of shares, and I am the only one who buy 1,000 number of shares. So therefore, I hold 100% of shares. All right. But however, later on, the same company, BAFS Limited, issues another 1,000 shares to another person. So right away, look at my percentage of holdings here. I get only 50% of shares. Why? Because I hold 1,000 number of shares, and now the total number of shares issued by this company is 2,000. So you can see right away, percentage of number of shares I get, okay, drop right away. All right, so next, the same company issued another 1,000 shares to another person. Oh, what do you think? I hold 1,000 number of shares, and now the company issues 3,000 altogether. So what is the percentage I hold? I hold 33% of the shares. All right. Okay, so this is the meaning of dilution of control happens to issuing of shares. Of course, this will be one of the disadvantages for issuing of shares, and the advantages for issuing of debentures and issuing of shares is same as what? Same as equity financing. And issuing of debentures is same as debts financing. So if we make comparison for advantages and disadvantages, this is one of the thing, which is dilution of control. Okay, so the next reason for issuing debentures, okay, same as the next advantage for issuing debentures, which is enjoy tax saving on interest expense. Remember in the previous lesson, what is interest? Interest is tax deductible. But however, what about this one? If we issue shares, we need to pay dividend, and dividend is non-tax deductible. Okay, so therefore tax deductible, when we pay interest, this will be advantage for issuing debentures. However, dividend we pay after issuing shares, this will be disadvantage because it is a kind of non-tax deductible. All right. Okay, so one more reason for issuing debentures, that is we can enjoy leverage effect. What does it mean leverage? Enjoy leverage effect. If we borrow money and then we can make our business successful, so we enjoy this leverage effect. All right, so next we have long-term bank borrowings. Now be careful, it must be a long-term one, not a short-term one, because the amount you need to get for taking over is large. All right, so the first reason is no issuing costs. So then which one needs issuing costs? So when we issue shares, we need issuing costs. So let me explain this to you. So issuing costs happens when we issue shares, because the procedure for issuing shares to the public is quite complicated. You need to pay administrative fees to the lawyers, to the accountants. But however, if we just borrow money from the bank, you don't need to pay this issuing cost. So therefore, the issuing cost here has a comparison between long-term bank borrowings and issuing of shares. Okay, so this one, enjoy tax saving on interest expense. This is same as this one, because both issuing debentures and long-term bank loans, these two are a kind of debt financing. So you have the same advantages here, as interest is a kind of tax deductible. All right. So next, same, benefit from leverage effect and also benefits from leverage effect. Finally, we have a very special point here, which is liquidation on fixed assets. You can give me highlights. So in your notebook, okay? And fixed assets is same as non-current assets. For example, you may have buildings, you may have furniture and fixtures and motor vehicle, and then you can always check, all right? So do you need them in your business? If you don't need them in business, you can think about liquidate them. That means you sell them so that you can get money to do financing to take over another firm. So this is the idea of liquidation on fixed assets. Okay, so if you make comparison, the good things are no issuing costs. So when you compare for issuing of shares, all right? So no interests, so you don't need to pay interest. This is a good thing. This is the advantage when you compare with issuing debentures, right? And then you don't need to pay dividend. You don't have dividend burden if you issue shares. And finally, this is special, fully utilize the financial resources. So you check if you have redundancy about all these things because you're not going to use it. You can think about sell them all to get back money. So that is about liquidation on fixed assets and liquidation on non-current assets. Okay, so after explanation on these two, and then we make comparison. Here we have a very good DSE question, so which is in 2015 about the difference between debt financing and equity financing. So if we issue bonds, debentures, and loan, we call that debt financing. If we issue shares, we call that equity financing. So you have a very good example here to study the difference. And then you can add this table to your handout to upgrade your handout. All right, so next we come to the question in 2013, and the question is sources of capital for raising how much? So this is 100 million. This is 100 million. Oh, you can see the amount is huge. All right, so you check the background for this company, which is Yummy Group. It's a listed fast food chain. So how do you get sources of financing? This is listed company. You can issue shares. You can issue long-term bond. So it must be long-term instead of short-term because the amount is so large. All right, and again, borrow long-term loan instead of short-term loan. So because the amount is 100 million. Okay, so another special thing, which is set up joint venture. Remember what is meaning of joint venture? Okay, so set up joint venture means an arrangement between two or more companies to work together on a particular project. And what is your project here is to set up an organic food restaurant, and then you need a large amount of money, which is 100 million. All right, so this is a very special answer as well. So next we do comparison for these two questions in 2014 and 2013. So the amount we need to borrow here is 100 million, all right, which is a huge amount, so that we always have this long-term bond and long-term loan instead of short-term bond and short-term loan. So therefore here the question is purchase of planes, airplane. So how much airplane? Very, very expensive, and the amount is huge. So what about if you use short-term loan? Oh, that will be a problem. So you should not use short-term loan. You should use long-term loan, right? Okay, now let us look at the problem here. So you may not be able to renew the loan because the amount you borrow is less than long-term loan. If you don't have enough, you need to re-borrow again, and then you may not apply successfully for that. That is the first thing. And then the second thing, even though you can successfully apply a long-term or renew your loan, your interest will be very high. So you can see this is a problem if you use a short-term loan to borrow a large amount to finance a very expensive thing. Okay, and finally, we have something new here, which is matching principle. So the accounting students, they know well about this concept, but this point is new to us. Okay, so let me explain to you here. Matching principle or matching concepts. So how do we calculate net profits? Net profit is calculated from total revenue minus total expenses or total cost, and the minus sign here means matching. We match these two things together, otherwise there's no meaning for whether we make a profit or make a loss. All right, for example, let's say the tuck shop in our school can make sales which is 2 million. Wow, this is terrific, right? Okay, but what about if you study the cost of goods sold and let me tell you it is 3 million? Oh, then what do you think? So you can say this is a good result or not a good result at all? No, not at all, right? So therefore we must match these two things together to give us meaningful thing. This is the idea of matching concepts and matching principle. All right, so that the conclusion is, according to matching principle, non-current assets, they are all durable and used for a long time, must be financed by long-term funds. Okay, now we have the next question in 2017, and which is list 3 types of methods that Marco could use to finance his 5-year expansion plan. All right, so who is Marco? Marco is the owner of a sole proprietorship. So means only one owner. All right, so if your answer is issuing shares and issuing bonds, and then your answer will be wrong. So this is very, very important. And also look at this expansion plan. How long is it? 5 years means a long-term plan. So that if your answer is short-term bank loan, and it will be also wrong. So be very, very careful about that. Okay, so let's look at the method that Marco can do. He can do self-finance. This is the term. Okay, what is the meaning of self-finance? Self-finance is same as the owner contribute more money into the business. So the double entry will be debit bank and credits capital, because of business entity concept that you have learned in Form 4. Is that right? But however, this question, not only the method, you have to look at the disadvantages. Of course, he's the only owner of the business, and the sources of fund must be very, very limited. Okay, so and then next, Marco can invite more his friends or business partners to form partnership. Here you can have disadvantages, same as a partnership. All right, and then Marco can set up a private limited company. All right, and this is the disadvantage of a limited company. And also here, long-term debts. Okay, your answer must be long-term debt. You cannot have a short-term bank loan because this is about a 5-year expansion plan. All right, so disadvantage, fixed obligation to repay interest and principal. So this is exactly same as the disadvantage of what? Of debts. Debt financing. Okay, this is it. Okay, so the last question in today's lesson is the question in 2019. All right, so reasons that Fortune Cinema should not borrow further from the banks, because the question is here. So the gearing ratio is high. All right, remember the formula for gearing ratio? We have non-current liability plus preferred share capital over non-current liability plus total shareholders fund. Since this ratio is already high, that means, okay, the burden for paying fixed interests and the burden for paying dividend is already high. So this one high is same as higher financial burden, because you have this fixed obligation to pay principal and interests. Okay, so that therefore the answer for the first point and the second point explaining why, okay, it is not good to borrow money further from the bank. All right, so we have another special point here, which is lower flexibility and control. So this is also one of the disadvantage if you borrow money from the bank, because the bank may impose restrictions on the fund usage. Therefore, after you have borrowed money, you don't have the freedom to use the money whatever you like. So this is same as if you go back to the question in 2015. All right, so flexibility and control of the fund usage. This is a kind of disadvantage to debt financing. However, an advantage if you make comparison for equity financing. So here we have another special thing, and the question in 2019, lower flexibility and control if you borrow money from the bank, which is debt financing, over equity financing. All right, so part B in this question, you have to identify what kind of source of long-term financing, and the condition is this. This company finds funding from the existing and new shareholders, so you have to identify. So this is issuing shares, so it must be equity financing, and after that you have to give disadvantages for equity financing. Now be very careful. If your identification is wrong here, so then you will lose all the marks for these disadvantages. All right, so since we have identified this is equity financing, so you will know straightforwardly that these are all the disadvantages for equity financing. Okay, so keep working hard. Thank you for watching my video, and then I will see you next time. Bye bye.